Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster. As always, thank you for tuning in. This episode features Adam Wyden. Adam stops by and talks about his philosophy, shares some lessons learned. It's a good conversation covering a number of topics, but I particularly enjoyed talking to him and the way he thinks about analyzing the mistakes that he's made, replaying the playbook, getting better all the time, focusing on what management teams are doing to build out the bench in order to make sure that the business is ready for the next 3 to 5 years of growth. And there's a number of things that I would take from it. And I just think it's an overall good conversation. You know, maybe it shows a side of Adam that people haven't seen before. So I hope you all enjoy the episode. I enjoyed recording it, and I've enjoyed getting to know Adam over the past few months. This episode is featured by Stratosphere.io, STRATOSPHERE.io. Rather than do the normal read, I'm just going to tell you, I was using it today, clicked on some filings. It brought me to Shad Rowe of Greenbrier Partners portfolio. I was going through different time periods of his 13F. Clicked on Apple, very intuitively took me to some segments and KPIs, and then clicked on the industry. Right now I'm looking at, operating profit margin, returns on equity versus all the comps in the industry, and just a very seamless experience. So, I think what Braden and his team are building over there is worth checking out. And should you want to sign up for the paid product, please use the promo code BREW for 15% off. But head on over to stratosphere.io for a free trial. Again, that's STRATOSPHERE.io. And give it a look-see. I think you'll enjoy what you find. All right. You know the drill. As always, none of this is financial advice. All of the information contained in this program is for entertainment purposes only. Please consult your financial advisor before making investment decisions and do your own due diligence. Enjoy the show. I am here because it's like hedge fund week in Miami. There's a bunch of vol guys. So my buddy Jason Buck wanted me to come down, invited me to dinner. And I was talking to some people about option pricing and vol structure and stuff. I don't know what the hell I'm talking about with these people, but I'm happy to be down here.
It's hedge fund week. Yeah, no, I'm not participating in hedge fund week. We went to Context and iConnections for several years, and it was always a nice reason to come down to Miami Beach, stay at the Fontainebleau, and meet a bunch of people and put a suit on. But what I found is that when you live in Miami Beach 24/7, the last thing you want to do is go to a hedge fund convention. And anyone that wants to see you when they're down for the hedge fund convention comes and finds you. So I've got a bunch of dinners planned this week, and it's sort of nice. It's sort of like, oh, that's how the other half lives. You live in New York, you come down for a couple of days. I'm like, oh, I get to live here around the clock. It's pretty nice.
Yeah, it is nice. It was kind of interesting. One of the guys that I was talking to, they basically, it seems to me, try to take advantage of market structure and specifically term structure. They have a theory that the front end of the options curve is basically artificially, not artificially depressed, but too cheap. No, wait, too expensive because of front end has too much selling because it's retail and stupid wealth managers trying to create yield. So they can buy that. And then I think they said they sell the longer dated stuff because insurance companies have to buy it. I don't know. They'll come on the pod and explain, but.
Oh, interesting.
I figured, I don't know. I was like, oh, I could see how a scenario where you can do value investing and options, right? Because basically that whole conversation was about exploiting the inefficiencies in the market that exist because of incentives.
Yeah, for sure. I mean, that goes without saying. I mean, look, options are a great strategy. I mean, look, if if properly used, if you're Mark Cuban and you get a bunch of Yahoo stock and you want to find a way and you're restricted in it and you want to basically, create a collar and basically lock in your economics, that's an exceedingly good way to basically, for whatever reason, you've got a large tax bill, you own a bunch of things, you have a large tax bill, you want to collar it, sorting against the box can be challenging because you have to take it off. But, if you want to collar a position, if you that you're restricted in, or collar position because, you don't want to necessarily sell it that year because maybe you think that this will be a year where the stock might go down or may trade sideways, but you want to be hedged from market, but you want to own it long term. I mean, look, there's a variety of different. I mean, another thing is, let's say you want to limit the capital that you have. I mean, think about it for a minute, right? If the actual investment itself is an option, right, where there is some binary range of outcomes, right? Let's say, there's a 50% chance it's a 10x, and there's a 50% chance like everything goes to hell in a handbasket. And you say, well, I want to put a 1% of my capital. Well, maybe the right answer is 1% of your capital in calls, because you say, look, I'm going to lose the 1% if it doesn't work. So why not magnify the upside in the context that it does work, right? You're sort of risking the same amount of capital. Now, obviously, there's plenty of issues as it relates to timing, sort of how you execute on that. But I think, options provide, a really nice way to sort of define your risk. I mean, use Carvana as an example. Lots of people were short Carvana. You had a mutual friend on your podcast who expressed, a short position in Carvana through puts. Now, there were plenty of people that were short Carvana, and if you wanted to, put a 5 or 10% position on in Carvana and it went up 20x in your face, it's like a GameStop scenario. Now, Let's say you were short Carvana at $200, and let's say you said, I think it's going to go to zero. And you put 2% in leap puts and you buy them out 2 years, and you're like, oh, well, if the thing goes from 200 to 400, you're probably not even losing all of your principal because you still have the time value and you've sort of limited your downside. Now, if the thing went from 200 to 5 and you had 2% of your capital, chances are you're still going to be making multiples of your money. So that would be a scenario where you'd want to express, sort of a short position with sort of, limited downside. So I actually think where puts and more importantly, just, broadly speaking, sort of these portfolio insurance things, whether it's a swaption, we heard stories about Michael Dell basically buying interest rate swaps on, something. There was a reason why he did it, but he bought a bunch of it because he wanted to sort of, hedge his interest rate thing. And then he was looking at the skew in the trade. And I think he put, I don't know, some insane, small amount of money, 15, 20 for relative net worth, but he put 15, 20, $30 million into these swaps. And I think he made billions of dollars on it. And it's sort of you think about sort of these portfolio insurance things. I mean, it's incredible how people sort of never price the risk of the, the sigma event, right? Whether it be, the 10-year going from, whatever it was, 2% to 4 or whatever, 1% or whatever it was to 4 or 5, or the 10-year isn't there, but let's say the 2-year rate at that, let's say the 2-year rate, was, I don't know, 1% or whatever, and now it's 4.25 or whatever it is, to have interest rates move that much that quickly, people couldn't really price that risk the same way people couldn't, price in, the risk of sort of the mortgage market imploding or whatever happened with high yield. I mean, look what Ackman did during COVID, right? He recognized that, companies could get really, really stressed. And he said, well, what would it cost me to buy portfolio insurance? So, I think, this whole concept of sort of portfolio insurance, I think is interesting that it always sort of misprices sort of the sigma events. And it's sort of why would anyone ever short a single name stock where you have, finite, I sort of think about it, I'm like, does it ever really make sense to short a single name stock? Now, obviously, if there are no options on it or whatever, but I sort of come back to the point, which is that you could have shorted GameStop all the way down and, and made 25% and, even had a 50 basis point GameStop position at the top and lost your entire fund. Something you know what I'm saying? So it's interesting how people think about sort of the asymmetries. And it's I think about shorting stocks. I'm it's just so asymmetric. Now, obviously you're shorting indexes, whatever, but I'm saying shorting a single name stock and it's it's very, very hard in terms of the asymmetry. Now, conversely, when you think about put options or credit default swaps or interest rate swaps or, any of these are, sort of bespoke securities that are supposed to sort of provide, levered protection. It's interesting the amount of protection they give relative to the amount of capital that is, effectively at risk, right? If you bought 1% puts or 2% puts on Carvana, I'm just doing the math. And again, it's out of the money, whatever, got to get the timing right. It's it's 400 and it's got to go to zero over the next 2 years. But I mean, if you bought, again, I don't know the exact numbers, but if you were short Carvana at 200 and you bought $100 puts on it out 2 years and it went to 400, I'm pretty sure you made a lot of money, many multiples of your money, so, look, you had your guest on here. He made, whatever, made 400% last year or something crazy. So, it's just interesting how people price risk and, the different securities that allow you to do it. I mean, obviously the best way to do it is to have a big position in something that goes up 100x, but that's the best thing, right? You hit a monster beverage and, Zygazant, you're good. But while we're waiting to find the next monster beverage, I do think that, sort of, finding these sort of interesting asymmetries, as expressed by, sort of options and this and that. I think it's just an interesting sort of thing interesting to us that the sort of the market always seems to price it wrong.
Yeah. I guess when I talk to the options guys, the things that my big takeaway is if I were to play in options for long enough, they would over the long term skin me. So I tend to avoid them, but I don't disagree. If you've got some sort of long-term view, like, Greenblatt wrote about it in You Can Be a Stock Market Genius, right? Using leaps to amplify your returns.
I had lunch with Joel Greenblatt last week, and it was just like it was like going to see the Pope. It was literally, I can't, like, he'd probably be embarrassed if he heard this, but it was like one of the best experiences of my life. I was like literally going there, and I had lunch with him. I was like, this is like seeing the Pope. This is the guy who wrote the book. This is the guy who did it. And it was just like, oh my goodness, like he's a living, breathing thing. I thought he was just some guy in a book. But yeah, I mean, it's incredible. I mean, look, it's not rocket science. I mean, it requires sort of, having the emotional fortitude and wherewithal and, all of the things that are, sort of required to execute on this. But yeah, I mean, look, yeah, Wells Fargo, that's a great example. He said, he goes, look, we were coming out of, I remember he was telling me about it. He's like, we were coming out of the S&L crisis, and, Wells Fargo was a super well capitalized bank. And I said, if any bank's going to survive, it's going to be this one. And I forget, he didn't remember exactly what it was, but I think he bought like 5, 6, 7. I mean, I don't remember the exact number, but he bought like some number, and he bought it out many years. I think it was 5, 6, 7% and of his capital. And it was there were leaps. So I think they were out a few years. And he was like, look, if the world goes to hell in a handbasket, I lose 1.5% a year. And I think he made a comment that they made like 8 or 9 or 10 times their money on it. By the way, Eddie Lampert did the same thing. I think Eddie Lampert, both him and Eddie both had, I know a couple guys that did it, coming out of 08, 09. Like a lot of guys, were, and it's interesting because you think about the banks were trading at such low multiples of book value in 08, 09, and you didn't really know what the book value was and how much more was going to get written down. But it was a very simple thesis, right? It was like, oh, well, these things are trading at 0.25 times 0.3 times book. But what people didn't realize is that if the economy actually rebounded, there was a natural reflation in the book value. Remember, if the world comes back, then, all the defaulted mortgages, all the things that had to quote unquote be written down, like they heal. There's like there's a reflexivity to it. There's some healing mechanism. So it's like, well, you could buy S&P calls, or you're like, oh, I could buy, banks. And I'm like, yeah, the banks aren't going to trade at 2 times book value again for a while, because they're going to be impaired, and they're going to be in handcuffs because of Basel II and III and all the different things that made them do crazy things. But, you didn't have to engineer too much to figure out that, like, oh, like these things could triple. Right? If they were 0.25 or 0.3 times book, you could sort of get to 0.9 times book, and, maybe they make a little bit of money, and you could sort of get it. And so a lot of guys, Tepper, I think, did it. A few other guys did it, where I'll tell you what a lot of these guys did is they bought these preferreds. A lot of these guys were buying the bank preferreds under the similar thesis, right? You're getting a coupon. These things were trading at, 30, 40, 50 cents on the dollar. And even if the equity got wiped, if they survive. But yeah, I mean, look, it's all about sort of understanding those things. Wells Fargo, I think they had IBM leaps, or Eddie. I don't know if Eddie and Joel both did IBM leaps. I know Eddie did IBM leaps. But, it's an interesting thing, because it's sort of like, if you're buying something that's exceedingly cheap from a micro perspective, you don't really necessarily need options to like leverage the return. But like, if you're sort of saying, hey, I don't know when this is going to work, I don't want to have an enormous amount of capital tied up in it, but like, if sort of the macro hits right, you can sort of, I think leaps are interesting for sort of macro plays, where it's sort of like Wells Fargo is sort of like, or buying Wells Fargo out of S&L, or like buying Bank of America, like in the middle of 08, 09. It's sort of like, okay, like, it's cheap. I'm not like smart enough to go through all of Bank of America's balance sheet and understand it. It's like, I know that if things sort of reflate and the economy comes back, these things won't trade at, 0.25 or 0.3 or whatever times book. And you'll make a little bit of money, and you'll buy it out a few years, and you sort of get a levered return that way without risking a lot of capital or tying up a lot of capital.
Yeah, and easy to say in retrospect, but if Wells Fargo's book is only worth 0.1 times, we might have some problems in the economy that it doesn't even matter anymore. Like, there might be a lot of zeros out there, and then you're talking about depression, right? Whereas you just say, okay, well, if we resume normal, I should get some juice on the backside, and leaps can add it. What do you ask the Pope when you meet him?
You ask the Pope when you meet him.
Do you ask him to bless you with the value investing
No,
Holy
I
water?
mean, no, I mean, I didn't ask for anything. I just wanted to.
No, I mean like just to get the conversation started. I can't imagine like that would be really cool to talk to him
Yeah,
in like a real setting.
he's just got an enormous amount of humility. He's just a super menschy guy. Like I think he truly loves what he does. I think very interested in giving back to the community, and he's got his charter schools. He's been a teacher, an adjunct teacher at Columbia Business School. I mean, I think he's just a lovely guy. I don't think you could meet a nicer individual. Which is sort of like, you sort of naturally think, well, anyone that's good in the stock business is sort of a jerk and they, eat people alive and this and that. And it's like, you look at this guy and like very disciplined, honest, hardworking, sort of self-effacing, lots of humility. I mean, we just talked about, I talked a lot about, sort of what my aspirations were for the business, how I sort of evolved from, doing a ton of sort of more eventy things with sort of a finite life, spin-offs and stuff like that, and sort of getting into it and then saying, can we use these events and these sort of special situations to start a good entry point for a compounder, and sort of how we built upon our thing, which is, can we find these things, whether it's API Group or PAR or RIC or whatever, can you find these things, some of the parts, deal within a deal, sort of an event, sort of special situations bend, but sort of allow that to sort of manifest itself into a compounder, which means that you've got to sort of buy high quality businesses that are misunderstood in an event. And sort of instead of just buying some crappy little business that was sort of, it was spun off and it traded at 4 times earnings and traded 8 times earnings, and, I'm in and I'm out. And it was just interesting to sort of talk about that and sort of, my evolution as an investor, and, sort of how he, what their evolution as an investor was, and, all those things. I mean, again, it's sort of like you're trying to build upon your process. You're not trying to do, sort of 180s, but like, sort of learning from what works and what is the, what is the right thing for sort of, sort of your mentality and your investor base and sort of your personality. And, what I'd find is that like, I don't ever want to be caught in a situation where like I own a business that's sort of suboptimal and I sort of miss it. And I've sort of like, well, you bought it here and you got to sell it here. It's sort of like, I want to be in a situation where if I underwrite the business right and the macro changes against me, I can sort of buy it on dips. And so, for me, it's sort of like, whether it was our experience with Fiat or whatever, it's like, we don't want to be in a situation where, it's like, oh, we own a lower quality business that like, people are never going to see as a high quality business. And we're sort of, chasing our tails on cyclicality. And so
what was your experience with Fiat?
We bought it really well. We bought it to own Ferrari initially. Then, Ferrari got spun off. We bought a bunch of Ferrari because it got super cheap and we liked it. And then the answer was, is as we, sort of, we, naturally as a spinoff investor, you'd say, well, should we sell Fiat and just focus on Ferrari? And the answer is we sort of did the study and we were like, well, it's still really cheap on some of the parts basis. It was trading at whatever it was, I don't know, 1 or 2 times earnings. And they had Magneti Marelli, they had the, which was their parts business. They still had Maserati and Alfa. And, there's other things in there that were sort of higher quality. And we sort of looked at it and we said, well, Sergio had done this sort of Confessions of a Capital Junkie PowerPoint presentation, basically saying, well, this could be like the defense contractors and return on invested capital is X. And if they all merge, return on invested capital is Y. But, again, you sort of were, I don't know, 10 years or 20 years early. Basically, the idea is that the auto industry needed to consolidate. The return on invested capital could be good, but how many years did it take for the railroads to get there? And, at what point does this, do these things get so large that like the replacement cost is the value and they're not all, spending the same money on R&D? And, there was just a lot of wasted economic capital that, basically facilitated itself in, sort of bad ROICs and ROEs. And so from our perspective, I think, we sort of overvalued sort of the blue sky. And I think in our minds, and look, I always joke around with people, like it's entirely possible that the mass market auto industry generates really good returns on invested capital. It might just be with 3 players in the United States or 1 player or whatever it is. And, it may be a scenario where, we go fully autonomous. I mean, Greg Alexander from Acacia, who's just an amazing guy, has this whole thesis that, these auto companies are eventually going to develop these subscription businesses. And, that business is going to basically quantify the entire market cap, right? If you're Fiat or GM and, you have, a SaaS element where like you manage the maintenance and, maybe some component of the autonomous and you're paying $100 a year or something like, or $100 a month and it's $1,200 a year. And, that's a SaaS business that, has low churn and this and that, maybe that, that sort of substantiates the entire market cap. So, again, I think things are the way they are until they aren't. And I think trying to call these turns is incredibly hard. And it's entirely possible that all the duplicative R&D and all the rest, that everyone is spending on electrification, this and that, these companies could merge and, the ROICs could get better and there's more pricing rationality and blah, 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 blah. And but that could be 10 years, it could be 30 years. And I think what we sort of, we're looking at was what this business could look like in the future and not what it looks like today. And I think the key is finding these businesses where it looks like one thing today, but it becomes something else very quickly. And, trying to find these businesses with their inflection points.
So are you focused on, I mean, I know M&A comes up when we chat and generally in the businesses that you're looking at, I think either M&A or organic opportunities. Like Rick, you've got the rollout of a franchise concept. API Group, I think, is more M&A. Is that fair?
I mean, look, I think ultimately, you want organic in every business. It's just the quantity of how much, right? And so everybody wants a Monster beverage where you have a brand and you call the grocery stores and you grow 50% or 100% a year or like a MasterCard or a Ferrari. I mean, look at Ferrari, right? They were growing volumes at 2% a year, and global high net worth individuals were compounding at 10 to 15% a year, right? And their net worth was compounding at 10% a year. So imagine a scenario where you've basically been compounding volumes at 2% a year, and sort of the TAM, so to speak, has been compounding at 25, right? The number of people have been compounding at 10 to 15%, and they've also been compounding their net worth at that. So you think about sort of that schematic, which is why, to me, that's why all this crazy stuff that's been going on with watches and cars is happening, because there's so many rich people and not enough product. They've massively underserved the market. And so from our perspective, it was okay, if Ferrari had a, 12, 15% EBIT margin, and the margins were obfuscated by, the Maserati engine business and the Formula One business. And we figured out that the incremental margin on a $300,000 or $400,000 car was 75%. And we said, okay, if they actually sell more cars, line is X approaches infinity, the margins are going to go from 15 to 50. And they basically did. The reason why we sold it was because they sort of increased production a little bit, which is more than 2%, but they didn't really look at it as a growth asset. They were sort of comfortable saying, okay, we're going to compound earnings at 10, 15%, for the long term. And that sort of didn't meet our threshold for return. But I mean, look, in a perfect world, we want organic, right? There are just very few assets that can produce the level of organic that can generate a 50 to 100% IRR, right? And so, MasterCard was a unique set of circumstances. I mean, God bless MasterCard. I need one of those in my life. Want a MasterCard, give me Hanson, give me a special situation setup, give me a demutualization, give me a spinoff from the banks, give me an IPO with 12% margins and 90% incrementals. Oh man, good night. You're good for life. And, they're hard to find. So I think in general, we want good businesses that are not cyclical. We want business with pricing power. We want, businesses with volume growth. But, look, if Rick is a 6% comp growth and 10 to 15% earnings growth, it trades at a 10% free cash flow yield. You'll make a 20 to 25 IRR, assuming no multiple expansion. Now, if you get multiple expansion, it'll be higher. And if there's M&A, they'll be higher. But I mean, again, it's sort of are there other organic opportunities at Rick? There are. They've got the franchising of the Bombshells. They've got these casinos that they're looking at. I think the Central City sort of Gentlemen's Club casino, I think will be amazing. I think, I don't know what the cash on cash return will be on that, but I suspect, and I think people are very negative, but, I suspect that, when all is said and done, they will be building these things at 1 to 2 times EBITDA, which is, better than what they're doing the gentlemen's clubs. Now, obviously you got to get the license. Obviously there's lots of things. It's hard to get a gentlemen's club license on a standalone basis, but, I think opportunistically, if they can grow doing M&A and organic, these different things, they can grow earnings, at least for the foreseeable future, 30, 40%. EBITDA and probably free cash flow faster. So, again, it's sort of the Shangri-La is that you have a business that's growing organically and doing M&A, and or a company that's growing organically 50 to 100%. But they're hard to find. I mean, they exist. I mean, if the growth algorithm for Ferrari was more in lockstep with what we had expected it to be, right, where they would have had a 4-door sedan and they would have brought the SUV out, there was a scenario to be had that Ferrari could have compounded earnings at 50 like MasterCard. But, Sergio died. Sergio was, this was going to be his retirement plan. He was going to get out of Fiat and do Ferrari and, make it a big thing. But, again, in any family run business, preservation of capital was sort of more valuable than a compounding of capital. I still think Ferrari is a massively under monetized asset. But, it's the same reason why we think Patek Philippe and some other companies. I mean, there are a number of private businesses that are doing. I mean, Chanel is an amazing company. I mean, Chanel, I look at what Chanel has done, and then I look at what Patek and Ferrari's done, and I'm like, look what Chanel has done with that brand. I mean, they've created entry points for all different types of Americans, low price cosmetics, high price handbags, shoes, couture. I mean, that business is one of the most well-run companies I've ever seen.
But how do you do that with something like Ferrari without diluting the brand?
Well, I mean, Chanel, did they dilute Chanel because you can go and buy lipstick at Saks?
No, and you don't have to go that far down market,
No,
right?
you don't. Well, I'll give you an example. How would Ferrari or Patek have done it, right? Well, Patek's not public, but how would a Ferrari done it? I don't think it would have been. So again, I'm a little bit dated on Ferrari, so humor me for a minute. But like when we first owned it, I think there were like 7 different models. There was like the 488, there was the F series, there was the the California. They had the special editions. But when all was said and done, you sort of had the FF. I mean, you had like 7 models. Maybe 6 or 7 models. And the argument is there were the speciales and the special editions and the, what do you call it? The they'd have sort of like the specials, and then they'd have the Iconas, which were like the super specials. But I don't think it would have bastardized the brand. And they've done a little bit of it. I mean, they brought back, sort of the Dino, I forget what the thing is. I think it's the Monza. The Monza is effectively the Dino, right? They've expanded the lineup a little bit, right? But like, if you think about it, Patek makes, I don't know, 200 different types of watches. They could have done a big SUV. They could have done a little SUV. They could have done a 4-door. They could have done, like in the old days, they had like the big saloon 2-doors. They have the 812 TDF, but like that's a pretty hard ride. So like, I think there's lots of things they could do where they wouldn't be increasing the units per SKU, but they're increasing the number of SKUs. And I refuse to believe that sort of the way you bastardize the brand is by making too much of any one thing. But if you're really in the collector's business, right, and I think Patek has done a better job of this, is like sort of expanding the lineup.
Porsche's done a reasonably good job, not as higher end, right, or not quite at the highest end, but I feel like they've done a pretty good job with some extensions.
Yeah, I mean, Porsche is a good company. I haven't really done a ton of work on it as a public company. I know they IPO'd it. I mean, Porsche, the challenge with Porsche is, they've got, you've got the Saxony and, Lower Saxony, and you've got pension, and you've got the government, and you've got a controlling shareholder. And, I think the question becomes there, it's like, who are you actually operating the company for? Where's the profit going? So, I think the thing that's kind of sort of kept us away from sort of doing more work on Porsche is sort of the economic incentives and the structure and the governance. But yeah, I mean, look, I think Porsche has done a nice sort of stratification, right? You got the GT3, you got the GT3 RS, you've got the GT2. I mean, I don't have the total figures on how many GT3s they're building versus how many the Ferraris are building. I know they've got,
they could build more GT3s if they wanted to.
Of course they could. And, they've got the Cayenne Turbo, they got the Cayenne Turbo GT, they've got, GT3, they got GT3 RS, they've got, GT2 RS. But yeah, I mean, look, they've got, GT3 Touring, GT3 Wing, they've got, they've got that stuff. I mean, look, they've got the Turbo S, it's more friendly. You've got the paint to sample counterculture.
Yeah, that's pretty cool.
Yeah, like Ferrari, Ferrari, you sort of, you can't, all Ferraris are Atelier, but like, the sort of the colors, going and picking it up in Germany, the exclusive manufacturer. I think what Porsche has done really well is their Atelier is much better than Ferrari. Now, that's not to say that Ferrari doesn't have a good Atelier. You can get Laura Piana in there, you can do all this stuff, but I think Porsche does a really good job sort of marketing it and sort of, letting people, it be available to people. I mean, I also think in general, just like the Porsche is a more understated car. It's an easier car to sort of daily drive. I think it's, and also I'll tell you the other thing about Porsche is they've made it upwardly mobile, right? So again, going back to it, it's like you can buy a Boxster
without diluting the brand.
Exactly.
Too.
So like you have a Boxster at like whatever, I don't know what a Boxster costs, 60, 70 grand. It's like not that much. And, and it's sort of like the price of entry, but you got the Cayman. I think they still have the Cayman, although I think it's called something else now. I think maybe it's called like the 718, but like they've sort of got a mid-engine car. They've got, whatever the Boxster, they've got, the electric, they've got the Taycan, they've got the, and then they've got, the 911 and then the S and the 4S and the Targa and the Turbo. And so, I think, they've sort of created a counterculture of sort of being upwardly mobile and sort of, getting, an entry into the brand. And, some people would argue, well, if, you can get into the brand, at a low price, that's no good. But yeah, no, it's interesting. I mean, I think building brands is super interesting to us, and sort of understanding, sort of how you acquire customers. And even like with a company like PAR, when you're selling software and you're like, oh, well, I'm going to sell them this module. And then as their business grows, I'm going to sell them more modules, right? Like the thing that people want, right? Whether you're Paddock or Ferrari or PAR, is you want to grow, you want to be able to grow with your customer. You want to be able to upsell them, right? So you sell a guy a Paddock and, he's 30 years old and he got his first bonus, and then suddenly he's 60 years old and he's got, a whole case of them because he's become in love with the brand. Same with Porsche, same with Ferrari. In PAR, you start selling, one software module to, that what we want with PAR is, we want to find, a Kava or a Sweetgreen or one of these companies, that's 100 units, and they take one product, and then suddenly you find them, 10 years later, and they've got 3,000 units and they got all the products, right? That's the Shangri-La, right? You find a customer that you can grow with and upsell and develop a more sort of, more global or multi-dimensional relationship. I mean, that's what we're trying to find with our investors too, right? Like we want to find people that, are sort of like, hey, we want to grow with you and be with you and have a multi-dimensional relationship. You're not just investing in a tear sheet, you're investing in a person, and, you guys both can grow with one another. But that's sort of the challenging part in business, right? It's sort of like, making it personal, being sort of a day-to-day guy, like really, and a lot of companies do this poorly, right? Like, and I think really good companies like Chanel, like Porsche, it's like they obviously, differentiate between a Boxster and a 911 Turbo S and, all the rest. But like at the end of the day, like they want you to grow with them. They want you to be able to afford to buy that big car. And I think, that's important, right? To value sort of the life cycle of a customer and people, and sort of being, personally invested in sort of that success. Like you don't want to be like, oh, you can't afford this, blah, blah. It's like, no, we want to help you. We want to be with you. We want to grow with you. And I think that to me is sort of elemental to business, whether it's, in raising money for a fund, or whether it's a company providing software and services, or, a company that says, hey, we want you to be part of our counterculture, and we don't care that, you can't afford X, Y, and Z Atelier, or, blah, 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 blah. Like, you got to start somewhere. And yeah. I think it's just, there's such a human element to everything that we do, like just understanding like what are the incentives of the company, of management, of people. And I think people just don't put enough, sort of effort and energy into sort of understanding, how emotionally invested and sort of the, the human element to all this.
How's sort of like that philosophy? How do you cultivate the LPs that you have? Because, you're heavily invested alongside them in the fund. This is your primary method of gaining wealth for yourself, right? So how are you aligning yourself with your LPs?
Yeah, it's a great question. I mean, look, obviously, when I started this partnership, I started with very little money. I actually had, a personal.
How did you start?
I had been investing for a really long time. My great uncle was a day one investor in Price Club and Qualcomm. And, his thing was, invest with, guys that have more to lose than you do. And, that, led him to Saul Price and Erwin Jacobs. And he started he was actually the day one investor in Hot Topic. He started a regional bank with, that eventually got sold to Golden West Financial, and then Wachovia, Herb Marion Sandler. And he was just a, really a wonderful, lovely guy, dyslexic Jewish guy, really, really lovely. And, I'm so lucky to have known him and sort of learned a little bit. He died very young. And then I had another, sort of cousin who worked for Stanley Gold at Shamrock and sort of took over this, jackup drilling company called UTI Energy that had effectively merged with Patterson. And, I the two of them just had such a grand old time doing what they were doing, building these businesses, meeting new people. I'm like, man, I got to do this. And, I got some stock.
So what age are you when you think like, I got to do this?
I was like probably like 13 or something like that. I was young, 12, 13 years old. I was always interested in business, but I sort of had businesses growing up. I'm a huge gearhead. I had a car detailing business in high school. I've just, I love cars. I, built remote control cars in, middle school and sold them on eBay. I had a car detailing business. So, I was always sort of, doing, sort of doing things to make money and sort of building small businesses. But, I was always interested in the stock market. I worked at a big fund, summer of my junior year, and it was interesting, but it sort of was like, I think it was, sort of more of like a traditional hedge fund with trading quarters and this and that. And it wasn't a good fit for me interpersonally. So I went to go work for sort of a boutique merchant bank out of college, and a guy there.
Oh, interesting.
Yeah. So a guy there, lovely guy. He had lost both of his parents in a car accident, and he inherited a little bit of money, and really, really lovely guy. And he said, "Oh, you got to read these books." And I had read a little bit on Buffett, but I hadn't read Snowball yet. And I can't remember if I'd read Margin of Safety or Intelligent Investor, but he said, "You gotta find this guy, this Jewish guy. Went to Penn. Turns out he was in my fraternity, Joel Greenblatt, the Pope." And he's like, "You got to read these books." And I was like, oh, and I just like, it blew me away. It was like there was darkness and there was lightness. It was like the guy wrote in a way that was so sort of elemental. I was like, oh, wait, like, you're telling me that, like, there are ways to screen for companies, like, return on invested capital, spin-offs, buy, insider buying. There were all these things, and it sort of all kind of came together at once. Because remember, Capital IQ and Bloomberg and FactSet, those things were relatively early. This is 2006. And so I was sitting there with all these sort of tools, and I was like, oh, wait, I can use Capital IQ to, like, find all these things, like all these things that are in the book. Like, these guys, even when Joel wrote the book originally, the technology wasn't there. Right. So they would subscribe to news, Value Line and all these sort of newsletter things that were sort of aggregating data. And I was like, I actually have the tools to figure it out, using the technology here. And I was like, wow. And it's just, the light bulb went off. I was like, okay, it doesn't really matter. I'm not just like going and having some guy pitch me a stock, or, my grandmother or my great uncle or someone. Like, it was very much less of a top down where it's like, oh, I got an iPhone, let me look at Apple. It was more like, what are the companies out there that sort of meet these financial criterion that sort of are the, set up for 100 baggers, and, can I sort of create the technology or sort of the feeding mechanism to find these things? Now, obviously, that was contemporaneous. If you think about the timing, this was sort of contemporaneous with sort of the great financial crisis. So, I finished working, I think, the summer of 2008. I started Columbia Business School in January of 2009 in their J-term program. And I remember, just like, going through these screens, and I'd set them up, at Columbia, and I'd set them up at my former office. And I remember being like, oh man, I'm using this stuff. And then you have all these dislocations. Like, you have all the stuff that they read about in the books. And I'm like, and then you have, like, boku opportunities. And I just, while I was in Columbia Business School, I found these crazy opportunities. Like, I remember Rodman and Renshaw was like trading for like 10 cents, and they had $1 of cash, and they were run rating $1. And then we're buying it from 10 cents to 30 cents and sold it for $6 like 90 days later. I mean, wow, crazy shit, like crazy shit. I remember IDT. I remember I was buying it for $2 at $10 of cash and $10 of NOLs, and it was run rating $2 a share. And I remember putting like 40 or 50% of my net worth in that thing, and 15 months later, it was up 15x. I was selling it for $30. Wow. So, again, lucky, good, whatever, it was everything. It was very lucky to, like, right place, right time, was managing a small enough amount of money that, like, you could find these sort of opportunities. And, I basically graduated Columbia Business School. I was like, I don't know. Like, I don't know what I don't know, which is like, when I talked to all my mentors, they were all just like, whatever you're missing, I can't teach you. You're going to have to learn. And, one of my mentors said, you got to touch the stove and, burn your fingertips, but I can't teach you that. And so I just basically said to myself, I'm like, look, I'm 25 years old. There's generational opportunities out there, even still, in January of 11, even though we were off the bottom, 2010, 9 was up, 10 was up. But I said, these prices are still good. And so I just, jumped off the cliff because, I didn't want to be a situation where I was 40 years old and sort of, had all this sort of the creature comforts of, I was an entrepreneur. I wanted to, if I knew that I wanted to do it, why am I sitting around and waiting to do it?
Yeah. I think a criticism that's levied at you, perhaps improperly, and I think you deserve the question to be asked, but it's like, how much help did you get from your family and your dad's connections and whatnot? For those that don't know, your dad is a senator.
Yeah, it's a good question. I'll be careful the way I answer this. I think there were a lot of people that were actually afraid to invest because they felt like, well, if I have a relationship with Adam's dad, well, I certainly can't invest with Adam. That will show that, I'm trying to curry favor with him or this and that. So if anything, I think it probably hurt me. I think there were a lot of people that I had a personal relationship with that should have invested, but didn't. And, that was sort of hurtful to me. But again, like, I don't cry for me, Argentina. Like, I don't need anyone to invest because, because I'm the son of my father. They should invest because I'm good at what I do and because I care, and I'll, kill myself doing it. But yeah, I mean, we started with very little amount of money, and, it's largely been organic. And, look, obviously, we shorted stocks in the beginning. We're not doing a ton of shorting these days. We are volatile, but, again, it's like all I can offer to my investors is sort of the alignment and the fact that, I'm all in. And, I think up until last year, we hadn't even taken a dollar out even to pay taxes. And, I took out a tiny bit of money, I think at the end of 21 to basically, pay taxes. And, look, I'm all in. I mean, look, I could not be more aligned with my investors. I've got, the preponderance of my net worth in this thing. And, I want this to be my vehicle. And when I look at, Berkshire Hathaway, yeah, Warren Buffett did 20% a year annualized, but the secret to it was that he didn't pay tax, right? He owned the same shares. And I think what people realize is, people sort of conform their businesses, to sort of be commercial. And, we've been up, 100%, we were down, I don't know, 45% last year. I mean, for us, it's sort of like, it's much more important for us to get the stocks right over time, as opposed to trying to sort of conform a tear sheet that may look good on a pre-tax basis but not on an after-tax basis. And so really what we're looking for is investors that are much more comfortable. I mean, I think for the first 11 years in the strategies, we did 24 net before the drawdown. And if that 24 net is actually a 24 net, not like a private equity IRR, like a doubling your money every 3 years, and you're doing that with almost no taxes, like, you don't need to do that very long. So, a lot of the growth has been organic. Obviously we're a super significant investor in the fund. And, my hope is that, we will, be the largest investor in the fund. We were, and then, we've got a couple families, and we got one family that, technically is bigger than us right now, but that's great. I mean, look, that's what we want. We want people to, come in when, we're down. And I think, a lot of people say, you look like you get the investors that you deserve. And I think, while we've grown slowly, I think we've grown really methodically and sort of gotten investors that sort of behave the right way at the right time. And so, look, I started this at 26 years old because I knew that, good things take time. And, I think being long-term greedy, I think, is the right way to do it. And if you can, be methodical and thoughtful and, not take shortcuts, I think you can build a business to last. And so, I'm what I'd say is I'm proud of what we've accomplished. I think we've assembled an investor base and sort of thought partners that I think are supportive. And I think the key is just to continue to find people that sort of have the right economic alignment in terms of being taxable, in terms of owning quality businesses, and understanding that even though if somebody's giving you a 20% return and, it's 100% turnover, it's not really 20%.
Yeah. Did you ever go through the period of investing where you made the mistake of, like, I don't know, buying crappy assets that you perceived to be cheap? Or did you get mentors as a young kid that kind of kept you away from that line of thinking? I get the sense that you're looking at quality assets that are growing with people that you trust now. I'm curious if that's a development that you had to learn yourself, or whether or not
I learned
that
it the
was
hard
through
way.
osmosis. Yeah.
Well, everyone said it, but like, I'm stubborn, so I had to sort of learn it the hard way.
Yeah. What's something you're embarrassed that you bought at some point?
Oh, we had USA Truck. Now, but that was interesting because it was sort of a trucking company that was under earning. And I'm not embarrassed. In fact, I'm sort of proud. It's sort of like, okay, I did it, in 2013 when my fund was small. It's like I didn't do it when I was big. Now, JB Hunt's, intermodal is an incredible business, but that's more asset light. But, it was a pure play trucking business, and they had a truck brokerage asset. And the idea was, oh, well, they'll grow the truck brokerage asset and it's worth more than the entire market cap. But, very hard to sort of without technology, it's very hard to sort of build pure play truck brokerage. And, again, it was just like, it's like the core business was challenging. It was capital intensive, and it was sort of a sum of the parts thesis. And I think, we were sort of remiss to understand, like, well, this truck brokerage business is really just overflow capacity for our existing business, and it's not really a standalone business. Yeah. One example. Yeah. Done plenty. I was in Sears' hometown. That was franchise hardware.
SHOS,
yeah,
right?
Yeah. I hit that one hard. I got it.
I was calling the franchisees, asking them what they thought.
I got it. I hit it at the rights offering. I got it in the rights offering. Like, I forget what we created the asset at, $20. I think I sold most of it in the 50s. And, Eddie took it private at 2, but, that was an example of a business where, like, the franchise model made sense, except for the fact that, like, what were the unit economics for the franchisees? What are the cash and cash returns? And so, am I embarrassed? I mean, a lot of people like, oh, well, one guy, I was at the meeting today, he's like, oh, well, you own Carvana. He says, well, how do you feel about that? He goes, oh, I made money. I'm like, but you made money by accident. I'm like, Sears hometown, like, we bought it at a decent price, but, like, we sort of made money by accident. Like, the argument I would make is that, like, maybe the execution was worse than we thought it was going to be. But, again, I sort of come back to it and I'm like, you sort of underwrite a business model, obviously the price is the price, but if the business model sort of fails, well, the price is sort of irrelevant. So, we've done a lot of that. I mean, I've made plenty of mistakes. I think, I'm sort of proud that, we've been quick to sort of recognize our mistakes, or at least most of them along the way. But we've had plenty of painful ones. And, look, at the end of the day, we are an amalgamation of sort of our experiences and our mistakes, and keep coming back to people. I'm like, look, I'm 38 years old. I'm still standing. I keep getting kicked in the head. And, the hope is to not keep making the same mistakes over and over again and making different ones. But, look, it's, last year was, probably, we probably came in with probably too much exposure, but, our security selection was by and large pretty decent, some mistakes here and there, but no crimes against humanity, nothing where the business model has basically been disproven. Probably a little overweight duration and factor, but, again, in our mind, look, the market oversold sort of, interest rate sensitive assets. And, I think in general, the business models themselves are intact. So, I think over time, these businesses will grow and, sort of valuations will mean revert. But I mean, look, every single drawdown, you learn something new. Sometimes it's exposure, sometimes it's factor, but yeah, I mean, you're just trying to not make the same mistakes over and over again. And when you realize you've sort of, made a crime against humanity, i.e. a business model that will never work, trying to realize it as quickly as you can.
Would you, I mean, as a takeaway from last year, do you think that if there was an error, it's not hedging out a factor or trying to figure out how to hedge out some of the duration risk when valuations were where they were? Or is it a lot easier to say in hindsight than it was to live through?
Easier to say in hindsight, obviously.
Yeah.
But I mean, look, obviously in hindsight, like, you'd say to yourself, okay, like, par went down a bunch, and, you'd say, well, par went down a bunch, and, did you think that, like, things were going to go down as much as they were? And, was there a scenario where, like, the stock went from 90 at the peak to 60 and you bought put options and you wasted money? Now in hindsight, like, you'd say, well, if I bought 2% of puts and this and that and I gave it away, like, is it the end of the world? But yeah, of course, everything is much easier in hindsight. But yeah, I mean, look, it's probably, look, we bought a bunch of Playboy at $10. We sold a bunch of it at 40, or 45 on the way to 60. And then we kept the remaining portion. It was like a 2 or 3% position. It was sort of a stub. And, they got, they had a big, sort of consumer business that, was, and we took out more money than we put in, 2 or 3x, but it didn't matter. It's like we had a 3% position that went down 80%. Like, so I would say some of the mistakes that we made were sort of, marginal, like relative to like sort of the way we roll position sizing. Like, if you have a 3% position, it goes down 80%, it freaking sucks. But, again, it's sort of like a lot, what's worse, having a 30 going down 80 or a 3, especially when the thing, already took all your capital out of it. So, I'd say, hedging factor, if there was a sort of an efficient way to do it, obviously in hindsight, it would have been better. But yeah, I mean, look, these are all things that you sort of learn along the way. And it wasn't like I didn't know about factor, and then we talked about it, but I said, I sort of looked at it and I said to myself, I like these things. I can't really find a great way to sort of hedge the factor that's cost efficient and will give us the torque. We talked about it. It was like IGV, NASDAQ. I'm like, but the NASDAQ and IGV could go up. Like, I want something that really sort of isolates mid-cap software, and it's just, look, these are the things. These are the flesh wounds. These are the battle scars. And maybe the answer is I should have shorted some against the box, and instead of just doing that, maybe I should, if it had gotten overvalued or sort of, or I don't know. And you sort of said, I'm just gonna, short some against the box, and if the stock goes down, I'll take the hedge off and buy it back. And there's lots of things you could do in hindsight. But, again, this is, part of the game and sort of learning. And, and a lot of people would even say, Adam, I don't even want you thinking about this. But, look, I think, we have, people that say, if you were right on the asset, then, stop thinking about this, But again, I think you always sort of want to, me personally, I am a believer of sort of reading the tape and going back and watching the bad plays and trying to understand for them. And maybe you say to yourself, like, in the future, I won't be able to recognize it. I won't be able to do anything about it, but at least have the option to sort of, harvest the lesson and the learning and saying, okay, like, what could we have done differently? Could we have seen it? Could we have not have seen it? What would it have been that would have been allowed us to see it? And, in the case of PAR, it's like, it was at 35 and went to 10 and then, went from 35 to 90. And the question is, did the business increase? Did they grow ARR, 3X by that time? I mean, by the end of 21, they'd bought Punch and they'd done that accretively, but, it was a hard one. But again, it's sort of like, I keep coming back to it, which is that, like, if you're right on the business and you're right on the people, then, when things go down, it becomes buying opportunities. I'll tell you what the advantage of being hedged was, is that if you'd sort of had, and this is what Bill Ackman figured out, is that if you have sort of CDS or sort of out of money the puts, what it is a funding mechanism to add to the positions when they go down. It's a funding mechanism.
Yeah.
Right?
Yeah. Yeah, that definitely is. I mean, that's what I was talking to those guys about today, right? That now you got to know when to take the position off and when to use it for funds. But yes, that's exactly right. Do you tend to, I mean, I know you're looking to compound in excess of, I think, certainly average. I don't know what I'm allowed to say on a podcast and what I'm not. But does that lead you to smaller in general?
Yeah, I mean, look, as a general rule, we sort of don't want to invest in companies that are smaller than our asset base, just, as it relates to, we don't want to go over 10% and this and that. But I mean, I'd say in general, I think our sweet spot is sort of 1 to 10 billion in assets. Like, we want companies that sort of have enough scale that, like, they sort of, the public company cost drag. I mean, we see this where, the companies sort of, like, they're sort of subscale in the public markets and sort of, it's very, very challenging for them to sort of, get off the ground and hit escape velocity. So I would say that, like, the billion to 10 billion, I think is, or even billion to 5 billion. I mean, I think you want businesses that sort of have enough profitability, enough scale that they sort of can hit escape velocity. Because remember, if it costs you $20-30 million to be a public company, between Sarbanes-Oxley, but also the CRM, the ERP, the G&A, the this and that, you want to, when the company grows, you want to be able to, not sort of have that, growth be subsumed by, sort of, infrastructure costs. And so I also just think that, like, there are so many companies that sort of are microcap forever. They sort of bounce around between 50 and 70 of EBITDA, right? They buy something, it fails, the business, you know what I mean? And so I think, there are scenarios where, like Rick, for example, where in the middle of COVID, it got down to such a low multiple, we bought a bunch of it, and would we, in our asset size today, if Rick had blown up, would we do it? Probably. I mean, we wouldn't have been able to buy as much, on a percentage basis. But, it's I think in general, like, we want to find companies that sort of can, and the stock market's a relay race, right? People have different risk profiles. So if you can buy something that's sort of scratch and dent inventory, right? We call it the Porsche in the barn phenomenon. We want to find the Porsche in the barn that, if you clean it up, maybe you get a tire change or, brakes, but we don't want to do engine rehauls. And if we can find one of these things where we can get it sort of detailed and sort of get it on the road and driving fast, like, that's what we're looking for. So, like Rick, for example, like if Rick was $100 million at the bottom or 150 and, we can buy it, but we know that EBITDA can grow from 50 to 200, like, that's a business that we can grow with, right? And that's what I'm talking about when I talk about, like, we want to find sort of dislocated assets that sort of create, great buying opportunities on the front end and that we can grow with. And I think that to me is sort of, by definition, you can buy something small that shouldn't have been small. It's sort of my process, right? Like, if you buy
You're talking about valuation wise. Yeah. Small market cap on a business that justifies a much higher one.
Correct, right?
Yeah.
I mean, if I'm buying, if I think Rick is, 70 of EBITDA and it's $100 million market cap, and you think, that's a big spread. Now, the question is, if it's 100 and it's worth 700 or whatever number you land on, but that 70 can grow to 300, right? Because if you think about the, Chris Meyer talks about this in 100 Baggers, but it's, what is the etymology of the return? Right, you have to get elemental with it. Like, how do you generate it? What are the different things? So Buffett values securities and says, okay, what's the free cash flow yield? What's the growth? Right, that's the return over time. Right, and then if you get multiple expansion, that obviously augments the IRR. Right, and so when you think about these things, you're trying, if you're buying something at a 100% free cash flow yield, well, it shouldn't trade there, right? Even if it doesn't grow, it should be at 10%. So in that situation, you're like, okay, like I'm going to get multiple expansion just because, even in a steady state, it's not going to trade at 100% free cash flow yield. It's either going out of business or it's going to trade at like a 10 or a 12 or whatever.
Yeah.
So, I think you're trying to figure out, like, it's one thing to buy, like, if you say, hey, Bank of America, buy Bank of America calls at, 0.3 times book value and it's going to trade at 1, like you're buying something that, is fundamentally mispriced. But then the question is the reinvestment rate interesting, right? And
yes.
So what we're trying to find things is buying them dislocated or misunderstood or wwhatever you want to call it at a cheap valuation relative to sort of, exit value. Now, if exit value is low growth, maybe a multiple is X. And if exit value is, the company has a long growth trajectory, maybe the multiple is Y because it should reflect the growth rate, right? So sometimes you can buy a security and say, well, the free cash flow yield plus the growth is good. I mean, Rick today, even at 90 some odd dollars, we think the free cash flow yield is, 10%. And we think that they can grow earnings organic and inorganic at, 30, 40%. So that's a total return of 40 to 50%, right? Now, on top of that, we think a business that can compound free cash flow at 40, 50% shouldn't trade at 10 times earnings or 10 times free cash flow. So, if they don't get any more multiple expansion, we still get a great return, but we still think they should have a higher multiple based on the way their reinvestment. So there is some sort of reflexivity to the whole thing, right?
And then how are you thinking about like updating your growth assumptions as time goes on? Is it each quarter you're reassessing? Are you comparing to like what your model says? I'm just curious how you think about that.
I don't think we do it on a quarterly basis. Like, I don't think I'm so focused to say, okay, if they didn't buy this company or they didn't do this quarter. I mean, look, we review things and we sort of, we look at things far more than on a quarterly basis, but I don't look at a quarterly report and be like, oh, like they didn't do this quarter. Like, I'm sort of looking at it and saying, are they making progress? Like, is Rick's M&A strategy working? Do I think they're sort of lining up targets? Do I feel like they have an effective funnel mechanism to, find targets? Do I feel like they built out the internal infrastructure to sort of, generate enough leads and build it out? Do I feel like, this Denver thing with the casinos makes sense? Like, how are they thinking about it? So again, it's sort of like, I sort of review this stuff far more than on a quarterly basis, but I don't look at the numbers and say, okay, the investment has to change based on this quarter or next quarter. I'm sort of abstractly looking at it and saying, are they preparing for the next 5 years? Like right now, like when I look at Rick's, I'm like, okay, I bought it when it was distressed. It's not distressed anymore. Okay. It still trades at a healthy free cash flow yield. And I still think like, even if they don't do any more M&A, and they just grow organically, 6, 8, 9, 10% sales and free cash flow goes 10 to 15%. It's still like at a suitable return. But, and that's why, we're not losing sleep over it. But at the same time, like, the delta between a 20 and a 25 and a 50, right? Pre-multiple expansion would be, what are the things they can do organically, like the casino or franchising bombshells, or what can they do inorganically, like, accretive M&A, to sort of augment that return and sort of understanding sort of the product roadmap around that, right? And so, from our perspective, whatever he did over the last few years, it's more about what are the pieces in place that he's putting in for the next 5 years.
Yeah.
And we want to make sure that, like, I'm always sort of, thinking ahead, being like, okay, like, Stan Druckenmiller talks about, you don't need to, you're not preparing for what's happened, you're preparing for what's going to happen. And so, we're sort of making sure that like our companies are sort of, developing the next, 3 and 5 year plan. And that's where we're spending our time.
Yeah. So, before we came on, you were talking about the bench, right? So you're spending your time going out, meeting the people that are implementing the plans, assessing whether or not they're thinking correctly. Like that's where your time is spent. And then in the quarterly numbers or whatever, it's a byproduct of what's going on, but you're not concerned about whether or not they're hitting a certain cadence. Is that a fair summary of what you're saying?
Yeah, absolutely.
Yeah.
I think that's right. Like again, like business is a messy thing and it's done with humans, right? And there's human beings and you can tell very quickly whether people are locked in or not. And, if the CEO says, hey, we know we need to do this over the next 5 years, but we're focusing on this integration right now, blah, 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 blah. But they understand that they understand that they need to be, sort of developing the product roadmap. Look, business is messy. Shit, stuff happens. Like you got to figure it out, And so I think it really is, it's a qualitative sort of, it's a qualitative assessment that like people are understanding, okay, like businesses go through different iterations, right? API Group has this specialty contracting business, which, was a larger percentage of the business before, and now is a smaller percentage of the business. We think that might be holding back their cost of capital. And so, they've said publicly, I think on conference calls and stuff that like, that they wouldn't, they said I think they said at the analyst day, I can't remember, but they've sort of, said, look, we would consider monetizing it. Now, obviously, if it's a private equity firm, interest rates matter. And, they've got to basically, carve out financials for it. That takes some time. But, there are different things that go into it. But like, again, it's sort of qualitative. It's like, if a CEO says, oh, no, we'd never sell that, then like, okay, but like you realize that like if the capital intensity as a percentage of sales is much higher than your core business, and if this thing's trading at 10% free cash flow yield, but if it was a pure play fire company it would trade at a 3, you would sell it because you could sell it and use that cash to buy back stock in sort of the company that trades at a big multiple. So again, it's sort of like, well, we did activism for a long time, and I think. Not to say that we'll never do it again, but like, I really don't think I want to get back into that business because you spend a lot of time on the front end, with a lot of ego and a lot of arrogance. And, it's I think finding executives and chair people and stuff where the people are financially aligned with you, but also just like willing to sort of talk about, different options and, sort of have the humility and flexibility in the approach. And what we found is that there are situations where you have these owner operators and they own over 50% of the company, and, and it's easier for them to steal than it is to create value. I mean, look, we were in this company where, the guy, front loaded a ton of expense, told everyone he was going to do X, Y, and Z, front loaded a lot of expense. Maybe I'm too sort of, cynical or paranoid or too, what's the right word? Conspiracy theorist, but he basically tanked the stock and gave himself a bunch of stock, and sort of did this thing where like, oh, I took the stock up. I didn't want to use the stock as a currency to sort of buy other assets, even though he said he was going to do it, and use the equity to basically buy other businesses, take all that EBITDA to basically, build out the infrastructure, enrich himself, then tank the stock, and then give himself more stock and switch the board. So, look, it's very easy to sort of get involved in idol worship. You're like, oh, well, the nephew of the guy is doing, but meanwhile, he did a lot of things that were, to enrich himself. He told shareholders he was doing X, and turns out he was probably doing Y. And, you look at the amount of shares that he's, if you look at the amount of equity he's eroded shareholder wealth.
Yeah.
Right. That he basically gave himself a bunch of stock and, bought a bunch of businesses and used that profitability to, build out his infrastructure and build out, his comp base for his business. And, look, numbers don't lie, people do, right? I mean, that's just the reality. So, and it's not, again, if you think about how he started it, he bought control of this, public shelf, similar to what Brad Jacobs did. And, he bought 50% of it in an SPV. He had investors who said, we're buying into this holding company. The shares are held into a holding company. And we talked to investors. They said, yeah, we can't get our stock back ever. So basically he wasn't charging them any fees, right? He wasn't charging them 2 and 20 or anything like that. He was just like, give me the money to buy this, buy control of this public entity, and you're never going to get your money back. And you have no votes. So you don't unwind the SPV until you feel like it. Now, in this specific case, right, like, he basically got 50% control. He made everybody who sold them their business with shares to give them basically a voting agreement for an indefinite period of time. And I think that was the reason why he didn't want to do an equity deal in stock when the shares were up, because he didn't want to lose control and he didn't have a dual class. So, you have a control freak who says, look, I own 50% of this thing, I don't, yes, I could do a creative transaction, but I run the risk that I lose control of the asset, that somehow, someone else, me and my group isn't 50%. And so, if I issue shares to these companies that I'm selling to, or they're selling to me, I have their votes. And if I issue stock to an investor group, well, they're not going to give me their votes, right? So, look, I come back to it. It's like, it's much easier to be a control freak, right? Than it is to create value. And, ultimately, like if you're accessing the capital markets and you're doing the right things, people will vote with you. But it basically is, sort of elemental in that, like, he didn't want to dilute himself, even though it would be super accretive to his value, right? Like in his mind, he's like, well, if you had issued stock to buy a chemicals distribution asset or something like that, if he was trading at 40 times EBITDA and he could buy something at 8 and do it all stock, well, that you do that all day. That's a Henry Singleton. But he was so worried about giving this guy stock, that he lost the vote, that he said, you know what, I'm not going to do this. I'm going to wait until the stock goes down and give myself a bunch of equity. And I come back to it, which is if you issued stock now he did a bunch of little transactions that were not that dilutive, but what he should have done is raised equity third party through a bank, right? Which is what Brad Jacobs did, which is what a lot of guys do. Look at API Group, right? Like when API went from 10 to 26, they did a preferred offering with Blackstone. David Blitzer joined the board and they raised common equity at $26 to go and fund Chubb. And they said, look, we're selling equity at, I don't know what multiple it is, 12, 10, whatever the number was. And we're buying Chubb at 6 times pro forma. And that's what we're doing. So you look at sort of the delta there. It's like, Chubb we think is like 450 or 500 of EBITDA pro forma. And, we look at that business and we say, look, that basically doubled the size of API Group. And you sort of look at Martin Franklin and what API did. Martin Franklin looked at this and said, he doesn't have a dual class. There's no dual class at API Group. Like, everyone has votes. Viking owns a bunch of stock, yes. But like, again, it's sort of like, they look at it and they say, look, Martin Franklin says we are our own activists. Right? Like, it's like, if we think that something makes sense, like we'll do it because we're owners and because, we are in the business of creating value. And like API Group is going to be an amazing asset that I think will be a, multi bagger like Jordan, but like, he's also in the business of building other public companies and like his reputation matters. And I think what you find in a lot of these guys is they're like, this is my first and last stop. He looks at this and says, oh, I got this business. I got this founder to sell this to me. I've got this opportunity. I'm never going to have an opportunity this good. And so they hang on to it so tight, because they're like, they look at it and they say to themselves, well, I don't deserve this. I'm not going to get another opportunity. And so they're overly focused on sort of maintaining control. And it's like, I look at it in business and I think so many people, sort of are contained with this zero-sum game phenomenon where they look at it and they say to myself, they're like, okay, like, I look at stocks, I say to myself, if a security becomes overvalued, there's an opportunity cost because I can go and invest capital in something else. Why? Because I'm a fisherman. I know how to fish. Doesn't mean I catch fish every single day, but I know how to fish. I keep catching fish. And so many of these CEOs, they look at this and, I call it the Shawshank Redemption effect. It's like, have you ever seen the movie where the old guy is in the prison? And I got a few one-liners. It's like, I was writing an email to a board member the other day and I was talking about it. It's like, it reminds me like that movie Alive where the guy the board doesn't want to go after the CEO, but they should kill him. And they're like, they don't want to eat him. They don't want to kill and eat him. But, in the Shawshank Redemption one's a good one because I don't know if you remember, it's a wonderful movie. Stephen King is a genius, by the way. Like he's really just a genius, like a literary genius. And, there's that movie, what's the name? Tim Robbins. So Tim Robbins is the banker and he, does the escape and, is friends with Morgan Freeman. And there's this older guy who, went to jail and they finally let him out and he's working in the grocery store and he, is working bagging groceries. He's 80 years old and, he doesn't have any friends and he's lonely and like prison is his life. Like that was his final destination, right? He couldn't understand life outside of the prison. And I sort of joke about this, politicians are like this, most politicians, they get in the business, they're in the business of getting elected. And it's like, when they're not in politics, they like don't have a reason to exist. They don't have a skill set. They don't know what to do. And I think there's a lot of CEOs that sort of look at this and they say to themselves, I'm so enraptured with my little sort of fiefdom that like, they can't manage anything out of a paper bag, because when his stock was trading at 40 times EBITDA and all of these platforms, he needed to buy a platform to get into this new industry. And you were gonna have to pay 10, 12, or 15 times. Well, he wanted to pay 5 times because that's his model. He pays 5 times, half in cash, half in stock. And what he didn't realize is that like, if he had gone into bought in a platform, in boilers, in this and that and the other, maybe he would have paid 15 times. But if he was issuing equity at 40 times, and maybe some of the equity goes to seller, or maybe some of the equity, this is what Brad Jacobs did. If you go look at Brad Jacobs or Henry Singleton, a lot of these guys issued equity to sort of primary shares to third parties to sort of finance sort of the roll up, and he didn't do it. Why? Because it would loosen his grip on the company. He only wanted to sell stock at low multiples. Think about this. If you're buying things at 5 times EBITDA and you're trading at 40, well, you're not issuing that much stock. It's half cash, half stock. And by the way, and they're voting with you. And he was able to offset that dilution for the little deals by just giving himself more equity. He wouldn't have been able to offset the dilution to his voting control on a big deal, right? If you're trading at $400 million and you got 10 million EBITDA, and you want to go and buy a business that's doing 10 or 15 of EBITDA, and you're going and you're paying 15 times, that's 225, you're giving a third of the company away.
Yeah.
But it's the right thing to do.
Yeah.
I mean, we go off on a tangent, but I think it's just such an important thing. Like,
so what was he selling when he was doing this? Was he selling a multiple arbitrage story? Like, I'm buying things at 5, I'm trading at 40, look at how accretive this is, or something like that?
He basically was like, we're buying these businesses at 5 times. He bought a couple. He did something very untoward in the beginning, by the way. He got control of the first asset, and then he was already public, and he found another asset, and he did a private placement to his own group instead of doing a rights offering. So instead of allowing everybody to sort of participate in the financing to do this thing, which is what would have been the right thing, he did a private placement to himself. Again, to basically maintain control, and because it was a good valuation. So, he bought that thing at an incredible, he was trading at, 8, 9, or 10, and he basically bought that at 5, and he was like, oh, I'm going to, the pro forma is going to be, 6 or something, because they bought a business 3 times the size of theirs. So they basically bought a business with cash, but that was funded with you see what I'm saying? And they were doing, and so, again, it sort of starts, it's all elemental, right? And, and that's it. And I had, one of our investors said to us, when they did this rights offering, he said, why didn't they offer it to everyone else? And he saw it. He knew immediately, and I sort of wrote it off at the time. I'm like, oh, well, they need certainty of foreclosure at cash, but, and you could sort of justify it in your head. But when all said and done, like, someone who is so cavalier with their investors, both their private investors in their SPV and the public investors, when, he did a private placement to a second SPV to fund a really good acquisition, it sort of tells you how he's going to treat his investors. So he basically gave them no information. He basically, they acquired a lot of revenue really quickly. He didn't really communicate what his investments were. He basically, took all now he gave you the EBITDA for the M&A, what he was buying, but he didn't tell you what he was investing in, what he was doing. And so, the stock ran up. He did more M&A, I think he basically thought, he goes, well, if I tell anyone anything, I'm going to lose the mystery. It's like the big, the strong silent type. It's like, if I don't tell anyone anything, maybe they think that I'm up to something. And so he sort of did that for a while.
How long were you in this before you were like, all right, enough of this crap?
So it's a great question. I started buying it. I remember it was Rosh Hashanah of September 16. Hey, Rosh Hashanah, I remember looking at it, and they'd just done the deal. And I think I bought it, started buying it. It was hard to buy, like $7 or $8 initially. And we bought it all the way up. But that was September of 16. And I think we sold our last share, early 20 before COVID. So 17, 18, 19, 3 years, three
You
and a half
dealt with
years.
a lot of crap.
Oh my goodness.
Why rather than just get out of it and be done with it?
Because it wasn't apparent. Like, you couldn't see it immediately. Like, we started buying it at $7, $8. It finished 2017 at like $40. So we made 5 times our money in effectively, or whatever it was, like a year and a half or whatever it was. But what was happening is that and he kept doing M&A, but and he kept saying, oh, well, we bought this EBITDA, but then there's other costs, there's public company, this, that, and the other. And so, EBITDA was growing. I mean, what happened is it basically EBITDA went from 3 to like 10 and sort of stayed at 10. And I suspect what was happening is he was traveling around, paying bankers, paying lawyers, looking at lots of transactions, not doing any of them. And he just didn't want the transparency. Yeah, there's CRM, ERP, this and that. But like, if you're making good investments, then why not tell people how much they are? I think he was just wasting the money and, basically using it as his private piggy bank. Was he flying around on private planes? I don't know. Who knows? It's sort of hard to sort of justify. We've tried to sort of reverse engineer all the different sort of money that was going in and out. And yes, we do understand it is expensive to be a public company, but it was sort of hard to sort of get our arms around. But yeah, I mean, look, it sort of was one of those situations where, you sort of have a built-in gain. So you're like, okay, like, do I want to sell it? Do I want to pay the taxes? They have this currency, they're telling you, and it was also sort of like, they were saying, oh, we're looking for big deals. We're doing this, we're doing that. And it wasn't like, I couldn't, it was sort of like taking management at face value. And you have to do that next layer, which is, are they shining you on? Yeah. Are they saying one thing and doing another? And that was what this is sort of was a lesson in.
Well, I suspect that'll be a lesson that you'll take for a long time.
We spent about 30. I don't know how much longer we're talking about it, but it's like I talk about mistakes and lessons, and it's like I think the biggest risk in this business is you can develop A, investing with sociopaths, and B, becoming one. And if you are not willing to talk about the mistakes that you've made and the things that you've learned, then you're not growing. You're not growing as an individual. You're a sociopath, right? Like if you can't actually look people in the eye and be like, I messed this up. This is what I didn't see. And, lots of people, they can say, well, it's hard to see at the time. I'm like, okay, yes, it might have been. And it was. But if you're not running the tape back and you're not looking at this stuff in hindsight and being like, and saying, okay, like, is he telling me this? Is it, it's like, if he's telling me we're looking at this and the Rick guy's like, oh, we're doing all this stuff. It's like, okay, like, Rick is saying, he's doing this stuff. Now the valuation is better and there's a lot less downside risk, but, sort of, if I look at the transparency that Eric is providing relative to like the guy, it's like night and day. And it's sort of like, if you're transparent today and you're always transparent, then I just think it's an amalgamation of sort of cues, right? It's like, the level of transparency, the fact that they're telling you, they're working on these things, but they're not telling the public markets, like, it's like if a guy says, hey, says at the shareholder meeting, we're working on M&A and we're working on finding big things. And, they're just, telling people, what they want to hear. But like they're not putting it in writing and they're not giving you the disclosure around where the income statement investments are. It's sort of like, I just think transparency is you either do it or you don't do it.
Yeah.
And, sometimes there's a reason, sometimes there's a business reason why you wouldn't be saying something. So like my point is I don't know what my ultimate cost basis was, whether it was 10 or 12 or whatever it was. But like my point is that like, it was like the average, whether it was the guy who was selling him his business or whether it was, shareholders who acquired it. Like I suspect like over the last 7 years, the preponderance of the investors haven't made any money and he doesn't care because he just, keeps saying, oh, I'm long-term, this and that. And like, yeah, look, I get it. Long-term is long-term. And, look, in any given period of time, like, this has been a tough 5 years out for us too. Now we ended, but at the same time, like, what's the level of transparency and what are you trying to, do you feel like you have a duty to perform? And, if you said to him, hey, this thing's going to stay at $20 for the next 5 years, he'd be like, okay, whatever. But like, that's because he looks at it and says to himself, I'm building wealth. I keep giving myself shares. I keep, and so, his side of the ledger is improving. If, my side of the ledger doesn't improve if I don't make money. I've got a huge personal investment in this fund. Like, it's not like the management fees are substantiating anything. And it's not like I'm giving myself free stock. These guys are giving themselves free stock.
Yeah. So how, I'm curious how you, like, I'm just juxtaposing this to my perception of API Group. And I'd be curious how you found API. And if you just talk about that a little bit and then we can wrap up.
Yeah. I mean, look, API Group was interesting. We had an investment in this company, Diamond Resorts, which was a timeshare company that sort of was a broken IPO. There was a lot of really smart people involved. They sort of built the company. It was a company that was sort of this company called Sunterra, actually, that, Josh Friedman from Canyon Partners built before he started Canyon. And it was a nice timeshare management business. They'd had some sort of accounting misstatement or something, and they were getting delisted, and it was a nice business, 100 of EBITDA. And sort of felt like it was a good business, but sort of, poor governance. It wasn't like, there wasn't fraud or anything like that. It was just like bad controls. And this guy knew someone in the industry, this guy Klubeck, and they put together money from Guggenheim and Soros. They took it private with 100 of EBITDA, with, basically they vended in a timeshare agreement, and it ended up getting sold to Apollo for like $3 billion of equity or something. I think that's right. $3 billion. I can't remember. It was either $2 billion or $3 billion. I think it was $3 billion, but I can't remember. But it was a bootstrap transaction, like an original LBO, right? It was all leverage and preferred, and then they delevered. So, coming out of it, there was no, meaning, a lot less debt and 500 of EBITDA. So you can see about, think about the LBO math, at 6 times. I think it was $3 billion because I think it was like 6 times 500. That number is just sticking with me for a minute. I think it was like $3 billion, which is meaningful equity creation, right? If you're in for zero equity, effectively,
not bad.
So $3 billion of equity.
Yeah.
To split up among partners and probably public market shareholders. But the one of our now an investor of ours, said, hey, my, in Yiddish machatunum, but my daughter married this guy's son, and they're doing this fire safety and inspection roll up, and I sort of knew, it's a nice segue. I knew all the different sort of high quality business, because remember when I dumped, I like elevator maintenance, fire sprinkler, like garage door. Like I looked at all the different sort of, horizontal verticals that they could get into to leverage their corporate infrastructure. And fire safety was one that we thought was super interesting. Elevator maintenance, fire, HVAC, these are all great in businesses. HVAC was a great one. Wasco did HVAC distribution, but they didn't do HVAC service. There was a huge business called Service Logic that I was like, why aren't you buying this? It's whatever. But I perseverate so much. It's like you get me on a negative thing and I can't get off it. But it's a nice segue because it's sort of like good governance, bad governance, or bad governance, good governance. But like I sort of knew all these sort of what I call these really high quality industrial distribution service assets. I sort of studied the crap out of them. And so like I was so prepared for it. Like, you know what I mean? It's like you're prepared for the test. It's like we knew about fire safety.
Yeah.
We loved the business. So here it is. Here's this holding company that, there was a guy who was a chairman. Basically, this guy's father started the business. He was an absentee sort of executive chairman. The current CEO, Russ Becker, grew up from like 600 million to 4 billion in sales. They had a Danaher style culture. You went there and you're like, again, talk about like 6 people that could run it. It's like you go out to Minnesota and it's like, it's like Nike, or I can't even explain it. It's like you have cross-functional leadership. You have guys who've been in different parts of the business. I mean, it's like a Swiss Army knife. It's like no business I've ever seen before.
That's neat.
It's really, really cool. They have like a learning center. They have like, the controller wasn't up for CFO, so he ended up running a business unit. But it's just like, I've never seen anything like this. Fiat actually tried to have it. Sergio sort of had the cross-functional leadership, but it's just this idea that you can work in different parts of the company and learn different parts, and sort of creates sort of longevity of personnel and experience, and super interesting. This guy Paul Grunow had an HVAC family business. He came in, he ran one division, then he became the chief learning officer. But like it just you could sort of tell that they were really fostering leadership development. I remember with the CEO, he said, "Oh, management." He goes, "No, we don't have management. We have leaders." And so their log line is building great leaders. And when you go into the headquarters, you can see it. So, I basically looked at this thing and I'm like, okay, like they, this business, 35% of it was owned by an ESOP. They had a deal with Carlyle. They were basically going to sell the fire business, we think, to Blackstone at like a huge multiple, and then just do, lever recap, do a dividend recap on Shitco. And we basically figured out that like, now the CEO or the chairman wanted that as their legacy. So, enter Martin Franklin and API Group. They basically offered cash.
He SPAC'd it, right?
Yeah, but it was a UK-based SPAC, so they basically SPAC'd it, but different. The way it works is the capital is permanent. Like, so you don't have when you raise a UK-based SPAC. I mean, Martin put like 200 million in, so like let's start with that. And then all the investors, Viking, I mean, basically still owns the stock. They own 20% of the company or whatever. So like, this was basically a platform, a platform investment, not like a SPAC.
Yeah.
And they don't get any free shares day one, the way a regular SPAC is. They only make money if the company does well. So like the promote, so to speak, sort of gets earned out.
It's like an earn out. Yeah.
It's like an earn out. Yeah.
Interesting.
Yeah. And they don't get it on the whole
better incentive system.
Oh, much better.
Yeah.
Well, and if you think about the business since we invested, I mean, there was, I don't know, 375 of EBITDA. I think Martin was, has a history of building businesses, whether it was Benson Eye Care with Warren Kanders, which happened very quickly when he was very young, and then Jarden, which was sort of his big one. I mean, not that Benson Eye Care, I mean, I think he did amazing, but it was just off of a smaller base. And then, I forget what the market cap of Jarden was when they sold it, 12 or 15 billion or something from nothing. But, Martin, had a history, Martin and Jim and Ian and the whole gang, he sort of built his SWAT team, and now he's got his kids in there. And, he sort of built this sort of, this Mary Post of Capital, which, after Jarden, he sort of built out these other businesses. And so, Cute Burger King, which he did with Bill Ackman, that did okay. He did a couple other SPACs and before the financial crisis, but, not on a big scale. They were US-based SPACs. He hadn't, monetized Jarden yet. So I don't think he was in a position to write $200 million checks. Once he sold Jarden, had real capital and sort of could, write checks into this stuff. But, we sort of looked at it and said, Burger King was great, Jarden was great, and Benson Eye Care was phenomenal. And we sort of looked at this and said, hey, here's a guy who is an absolute stud and a winner. He made one footfall, which was this platform acquisition, this chemicals business. And they own it. They say, look, we bought a commodity cyclicals business. We didn't buy an in-place management team. We probably should have kept the management team at McDermott instead of changing things up. And, look, that was their worst deal, and it's going to be profitable. I don't know what the IRR will be. I mean, it's now Element Solutions, and, they divested all the garbage, and, it's a super high quality business. And so I looked at it and I said to myself, okay, like, you've got a guy with an amazing track record. He made one bad deal. I mean, look, even Nomad is fine, but you look at Jarden and you look at Benson, they were Adam Wyden style returns. And I said, look, here's a great business, fire safety with an in-place management team and good capital allocation. Like, can API Group create an Adam Wyden return? And the short answer is yes. I mean, you think about it, like, I think we started buying it at like $9 or $10. I think the stock's 21, and that's, over what we started. I mean, that's basically over 3 years, right before COVID. So 20, 21, 22. And, you had a huge pandemic, a lot of stuff, but even more importantly, like, they basically sold all the crap and they bought Chubb. And, when we bought it, I think it was 375, sort of like 50% fire. And now we think it's $1 billion of EBITDA and like 80% fire. So think about the mix, right? So, and it's not that the specialty business is a bad business, it's just lower multiple. But I mean, Leonard Green owned an asset called Pi Barker, where they sold half of it to Altus Partners in Toronto. I think Altus paid 23 times EBITDA. We think that API Group is trading at like 7 times. We think they'll do $1 billion or nearly $1 billion of EBITDA in 24. And, on that number, we think we're paying like 7-ish times. So why would you pay 23 times for a business doing 100 or 130 of EBITDA when you could pay 7 times for one that's doing $1 billion with a best-in-class management team?
Yeah.
So,
it makes sense to me.
Yeah. This to us is just like, now, do they, are they going to grow organically? Like, we think the fire business will grow organically, 7, 8, 9% sales. And we think that should manifest itself in 15 to 20% earnings growth as they're leveraging their structure, right? Because remember, if your contribution margin, like, they've guided to like 13% EBITDA margins in 25, I think it'll be higher than that. Like, we look at little decks of little fire safety, companies, plenty of them have locations at 30% margins. So, obviously more service, but as they get more service and they get sort of in more of the higher margin, business, do I think that, the fleet average store can do 18 to 20%? And if corporate is, call it 50 basis points of sales or something, can you, sort of get to high teens EBITDA margins on a consolidated basis? Yes. And, our point is that without the cyclicality and sort of the statutory nature of this business, we think that this business could trade at look at First Service, look at Rollins, look at Terminix, look at Cintas. These are 2 and 3% free cash flow businesses, right? So, you work backwards on the math, right? If it's a 5%, 20 times EBITDA, it's 5% pre-tax, and after tax, it's 4, this is a 20 times EBITDA business, right? Realistically, if you have a 4%, if this thing trades at a 4% free cash flow yield and it can grow earnings, sort of 15 to 20%, even 10 to 15%, that pencils out for sort of a closet index hugger at 20%. And my view is, if I can basically etch out an exit multiple where, this sort of the closet index hugger, the guy at the big mutual fund can sort of pencil out a 15 to 20% return, and I can, make a huge return along the way to get to that point, then we're money in the bank.
Yeah.
So
interesting.
It's a fun game, man. It's super humbling, man. have been really kicked in the head a few times. But I'll tell you that, it is rewarding to talk about, to say, look, at this point in time, we've got some good assets. We've got PAR, we've got RIC, we've got APG, we've got GFL. I mean, we've got some really great owner operator assets that are, sort of fundamentally mispriced, or where we feel like, that the path to value convergence is there. And, we're not, sitting here wringing our hands worried that these guys are going to steal from us. And, look, it's, Berkshire's had their share of drawdowns, and we have too. And, I think it's nice. I'll tell you this time around, I think what's nice about it is that, we do have the comfort of owning assets that are compounding in value, where, we know that over time, that we're going to get paid. I think that's a good feeling. It's like, I've been through it, like in 18 and 19, like I had to get out of EVI, like I couldn't do it. Right. So we spent.
Yeah. This time you're comfortable in the assets.
I spent a lot of time. Well, I mean, it's like,
and with the people that you own it with.
Correct. And so like coming into COVID, we had cash, and some of that was we were worried about the market, but some of it was also just like we had assets that, like, we sold Ferrari in the summer of 2019. We sold EVI because we weren't getting through to the guy, not in our best interests. And so, I think, we sort of like had to, we had API at the end of 19. I'm trying to think, we had RIC in the beginning of 20, but like, we had to sort of clean the decks and sort of, really recognize what we want and what we don't want out of life. And I think, I do think that, this feels very different now, because it's like, as you said, like we have people that we want to be in business with businesses that we like.
Yeah. Yeah. That's a good place to be. You don't mince a lot of words, Adam. Right? You tell people what you think.
Yeah.
I think on social media it gets you in some fights, but I'm not sure that those fights, I think if people met you face to face, they might think differently.
Well, I just think, look, I'm probably the biggest critic of myself. I've made so many mistakes. I've done a lot of things that I wish I hadn't. And, both, from an investment perspective and the rest. And I'm a humanist. I want to be better. I want everyone to be better. I really do like people. I really like gravitate to people and, people and energy, but I don't like phony people. And I really don't. And I think, there are so many people that live this sort of automaton life where they go into their office and they sit there and they're like, okay, like, let me look at this tear sheet. Let me read, this, that, and the other. And they're sort of looking for someone to conform into a certain thing. And it's sort of like, whether it's a guy at a pension fund or an endowment saying, hey, Adam charges too many fees, or, he's too volatile, or this and that. And it's sort of like, get on the freaking field and figure out how hard it is to do this. And like staying up till 5 o'clock in the morning and doing this stuff. And what we're finding is that, like, when you're in business with CEOs that like are, living and dying with it, like, there is a fundamental language that sort of is spoken and understood. And I think, I just think for me, it's sort of like so many people, they, whether it's on Twitter or hiding behind some sort of anonymous thing and like punting, writing mean stuff about people. And I just think it's, look, lots of people got crushed last year, and, look, myself included, and, no one is infallible. But I think, I think that so many people sort of have this Schadenfreude part of this, like where it's like, oh, this guy and that guy and this and that, and this guy's dad is this, and this is why it failed. And I'm like, no, like, it's just like, we're all humans. We all put our pants on one leg at a time, and, we all make mistakes. And I don't like this counterculture of just like, and I don't know if it's TikTok or Instagram, I don't know, Twitter, but it's just this idea that like we're looking at people's lives, and it's just so easy to like look in through the window and say, oh, this person is doing this or that. And I just think so many people, like, they don't actually get on the field and lace up the sneakers or the cleats and figure out what it takes. And I have so much appreciation for these little guys starting these businesses. And I've tried to make myself available, whether it's through Scott Miller and his Greenhaven Fund Partners funds and his field team of small investors, or people that reach out to me on Twitter. And, there are plenty of people that reach out, and I just try and make myself available because, again, I really do think that, you never know where the next great investment idea comes from. If some kid who's 16 years old has the next monster beverage, like, I want to know about it. And,
yeah.
I just think, like, the end of the day, the best thing we can do is sort of be honest with ourselves and with everyone else, and, show that we have the financial alignment, show that we do care, and that there's integrity, and, that I'm financially aligned with my partners, and that I will, break my back, for forever, because, I don't want to do anything else. I want to do this, and I want to win at this. And if I can't win at this, I'll give the money back. And,
what drives you at this point?
I think, it's interesting. I love the game. I was actually with Joel's partner, and he goes, look, I remember investing in this company. It was a demutualization of a Citibank. And he's like, I put like whatever I put 30, 40, 50% of my net worth in it. And he's like, I knew that I was going to like whatever, double, triple, quintuple my money. And he's like, it wasn't like when it actually happened, it wasn't even that, exciting because I knew it was going to happen. It was the thrill of spotting the kill. And I sort of relate to that. It's like the thrill of like the next score. It's the what is it? It's the satisfaction of being right and the motivation of being wrong. It's sort of like, I do think that I can add value to companies, and I think like in an intangible way, like if I can get involved in a company and make it better, I think that's satisfying, right? If I can, make the return even better, whether it's through talking about capital allocation or a business idea. But ultimately, like these CEOs are great, and like they don't need my advice. If I can help on the margin, I will, and I'm happy. But I think it's the game. I mean, I think it's incredibly challenging and thought provoking and motivating, and I want to develop a best in class track record, and like not at the expense of turning over my portfolio 100% a year. And I suspect Warren Buffett says you could do 50. I'm sure I could do better if my turnover was higher. Like I know I could, but would that create better after tax wealth for both myself and my partners? Probably not, right? If I was doing 40 net, but it was 100% turnover, like I'm not sure that creates a better result than where we were over 11 years, pre-tax, after tax.
Yeah. Yeah, the tax drag is a real thing and sucks.
Yeah, and the institutions don't care about it because they don't pay it.
Yeah. All right, one more and then I'll let you get out of here.
Yeah, that's what's all good.
What does being Jewish mean to you?
It's a great question. Look, my son goes to Jewish day school. Look, for me, it's an identity thing, right? It's like, it's I don't keep kosher, but I do. I don't even know if I believe in God. I haven't really made up my mind on this. But what I can tell you is that like the traditions, the concept of tikkun olam and giving back. I mean, I think, it's sort of like it's a way of living your life, right? Like living a righteous life. And I don't want to sound arrogant and saying, oh, well, Jewish people are the only righteous people. I mean, there are plenty of, Bernie Madoff was a Jewish guy. He was certainly not righteous. But like, my point is that like a lot of the lessons and teachings I think are, family oriented, tikkun olam, giving back to the community, making the world a better place. And, look, I've been, very fortunate. I was, member of ZBT, a Jewish fraternity at Penn, but they had non-Jewish people, but, unbelievable. And not to say, being Jewish is a great network and whatnot, but I just think like, it's the traditions, it's the family values, it's the, and I'll be careful the way I say this, but, look, Jewish people have been run out of countries and places for millennia. And, I hope that doesn't happen anymore. I think the United States is this is a little bit macro, but, I think the world is a much safer place than it's ever been. And I'm sort of optimistic. Someone said, well, how do you think about the macro? I'm like, it's interesting. I think if you look at the coordination around COVID and sort of interest rates and stuff, and also just like what's happening with the Middle East and the Abraham Accords, I mean, there is more coordination and more sort of, community. I mean, look at China. Like everyone thought China would come to Putin's back and they didn't. So, I would say that like, I am like cautiously optimistic that like, people are sort of now, I don't like, there are people, I feel like in a lot of ways, yes, there's class warfare, there's issues with money and this and that, but I think in general, globally, I think people are looking after one another a lot more than they used to. And that gives me hope. And, I think, because, Jewish people have, sort of, faced, and look, I don't want to measure it relative to African Americans or anyone else. I mean, there are plenty of people that have been, prejudiced and whatnot. What's going on in this country is terrible with the police and this and that. But I think in general, Jewish people have experienced some prejudice along the way and have been run out of town. And I think, do understand sort of the plight of humanity. And we've had many, there are many great things that business opportunities, this and that. Like, I've been afforded, many great opportunities. I'm sure some of them because I was Jewish or whatever, went to this school or that thing. But, look, I think at the end of the day, we are a byproduct of our experiences and, our energy and our passion and our ability to work hard. And, I just think that, many of the things that I've sort of learned from my parents and my grandparents and sort of, and my wife and her family and this and that, it's that, these are important traditions. And, I just, I I'm not to say that I wouldn't get it from another sort of sociocultural sect, but I think it's been really rewarding for me in terms of, this access to community and sort of understanding what's important in life.
Yeah, no, that makes sense. I mean, I think my wife would probably say a lot of the same things about Catholicism, right? And I grew up in a Jewish household, and I think that there are a lot of similarities. And I just know anyone that's talked to you, it comes up a decent amount in a conversation. So I wanted to ask you. So with that, I just want to say thanks for joining the pod, man. And, we can do it another time or not. And let's hang out for a bit. And thanks for coming on.
Thank you.
But it's absolutely necessary.